Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the ICT Balanced Price Range, the BPR, a powerful concept that can significantly improve your trading accuracy. If you have ever wondered how professional traders pinpoint high probability zones for entries and exits, you are in for a treat. The ICT Balanced Price Range is a key element in understanding price sensitivity and price and market dynamics. So by the end of this video, you will have a clear grasp of what the BPR is, how to identify it, and most importantly, how to use it in your trading strategy. So you stay tuned as we unpack the game-changing concept that could take your forex trading to the next level. Now, what is the ICT Balanced Price Range, also known as the BPR? This concept is designed to help traders identify zones of equilibrium on price charts where buying and selling pressure temporarily balances. It forms when opposing fair value gaps two opposing fair value gaps, one bullish and one bearish, overlaps. These fair value gaps are created by rapid price movement in opposite direction, leaving behind a low trading activity. This is the fair value gap, opposing fair value gap, both left and right side. This is the fair value gap in this area. Let me widen my chart so that you can spot that. This is basically what the fair value gap, the BPR, the balanced price range, is all about. The overlapping area known as the BPR becomes a key zone of interest for traders because it represents a point where market seeks balance after a period of imbalance. At this area, we can see that price must surely come there to seek balance. To better understand this, imagine market first moves upward aggressively, creating a bullish fair value gap. Shortly after, it reverses intensely, creating a bearish imbalance. This is typically what it means in this area. Moves upward violently, moves downward violently, creating both imbalance. The area where the two gaps intersect is called the BPR. This is called the BPR, where both indicators intersect. This is what is called. Now on a chart, we can identify by marking the boundaries of both FVG, fair value gaps. This is a fair value gap in the left side and this is a fair value gap in the right side. If we mark out both sides, this is the BBR. If you see a bullish fair value gap followed by a bearish fair value gap in close proximity, their overlap becomes balanced price range. That is the BPR. This zone is not random and it often acts as a key level of support and resistance. The importance of this BPR relies in the predictive power of price movement approaching this zone. It indicates that a strong reaction because institutional traders view this as an optimal point to enter and exit price. So whenever price gets to this BPR, we expect a strong reaction from price. Now let's see how we can incorporate this into our trading strategy. We incorporate using the balanced price range into our trading strategy. And we start by understanding that it's not just about the concept to identify, but the practical tool that can use to execute precise entries. The trade effectively use the BPR. You need to combine it with market structure analysis and other ICT tools like the price, the fair value gaps, liquidity pool, and other blocks. Let's break down the trading strategy step by step using for a bullish setup. To identify a bullish setup, a bullish ICT balanced price range, we have to begin by identifying the bullish market structure. And if we can go to the higher time frame to spot this area, we can see, let's go to the 4-hour time frame, and we can see that generally the market is in an uptrend. In fact, the market has broken structure at this area, signifying that we are in the retracement phase, and we have spotted a BPR within the retracement phase. Going back to that time frame, this further confirms our bias. After locating, remember that we located this thing at the pullback phase far below the discount area in price. Once you have identified the BPR in the discount area in price, we mark that area out and we set a buy limit towards the area. We can also confirm that price is trading close, the BPR was formed close to an order block. As we can see, this further confirms our setup, and as we can see, there was liquidity in the market that price claimed to take out when price was approaching the order block. The BPR further confirms our bias. We enter the trade. When we enter the trade, we wait for, first of all, price to enter this zone. When price gets to the zone, you can set your buy limit at that area. When price has gotten close to the zone, you set your stop loss just below the recent swing low. This is where you set your stop loss, and your target should be according to your higher time frame. You can take your profit at the zone where your higher time frame high is showing you. Now, switching this to my higher time frame, we can see that we can take profit at this high over here. If you want to be more conservative, you can take profit at areas from the lower time frame, areas of resistance. Remember, this has to happen in a discount region. From my Fibonacci, I can tell that we are in a distance region because this pattern forms below our 50% of the Fibonacci, signifying that we are in the discount region of this uptrend. And if we can see, price eventually moved to the upside. Now, when we look at the bullish setup, we can see that everything aligned in price, combining with your BPR and combining with the other blocks and liquidity. Now let's look for a bearish setup. For a bearish setup, the progress is similar but reversed. We start by identifying the bearish setup, and as we can see, price is trending to the downside in the market. From this area, we can see price is trending to the downside, creating series of lower lows, lower highs, and a lower low. This is a pullback to form this lower low. This is a pullback. As we can see, we are trying to trade the pullback of the bearish trend. So when we find out that our market structure supports our bias, we first of all locate our bearish fair value gap in the premium zone. Remember this, when I drew the Fibonacci, this area that we saw our BPR was the premium area on our chart. This is above 50% of the fair value of the Fibonacci retracement. It's above 50%. We formed this BPR, so it further validates this setup. When we spot our fair value gap, the bearish fair value gap overlapping the bullish fair value gap, this marks out our bearish BPR. When price retraces to the bearish PPR in this area, as we can see, we place our entry. When price gets to that area, we place our sell limit. When price gets to that area, placing our sell limit in that area, we place our stop loss just above the previous swing high. Then we aim for liquidity pools such as the next swing low or the upper swing low. This is where we aim for. Remember the key to an ICT balanced price range lies in patience and precision. Always ensure that your BPR aligns with your ICT concept like market structure. Always make sure that they align with the market concept like market structure or liquidity zones for additional confluences. By combining these tools, you can refine your entries and maximize your risk to reward ratio. Sorry, I repeat. I said by combining all these confluences together, the market structure, liquidity zones, other blocks, your BPR, you can be able to refine your entries and maximize your risk to reward ratio. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on your notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.